We saw gold up to record highs and palladium just smashing records. The thing is, how far do they go and what really is driving it? I mean, we know it's a geopolitical search for a haven, but how long can that go on for?
We tend to see the longer-term relationship for gold remaining intact, and that's its correlation with real yields. And when we see a short-term safe haven bid driving gold, it tends to be short-lived.
Just carry on with your answer about what the drivers are in the sense of that sense of looking for a haven and how long it does go on for.
We have seen gold prices rallying on the back of a geopolitical risk premium, and that has really pushed gold prices above 1900 and closing in on the all-time highs. And when we've seen a sell-off in the prices, whether it's on the back of profit taking, prices have been quite well supported. So any price dips have been viewed as a buying opportunity. So we generally tend to see that a geopolitical risk premium is short-lived in the market, and it tends to be a fleeting move higher. But when it starts to change is if we start to see a structural shift in the market in terms of longer-term investment demand. And what we've seen on the back of the geopolitical risks is that now with commodity prices across the board, sometimes testing multi-year highs or all-time highs, alongside more supply chain challenges and concerns that we could see inflation persisting for a longer period of time at a much more elevated level, has started to drive that inflation bid in gold as well. So initially, this move higher was being driven by tactical interest in the market, and we started seeing tactical positioning back at levels that we saw in 2020. But now we're slowly starting to see some of that ETF interest coming back into the market. For March, for the month to date, inflows are already up around about 80 tons. And then for the year to date, we're up over 150 tons. To put that into perspective, that's more than 90% of the outflows that we saw for the whole of 2021. So yes, normally we tend to see a move higher in gold prices being short-lived when it comes to geopolitical risk. But when that has a knock-on effect and in terms of inflation risk, that tends to overshadow rate hike expectations. And we could start to see the interest in gold being reignited and investors reevaluating what role gold has to play within a portfolio, whether it's for insurance, diversification, or for, given the heightened geopolitical tensions at the moment.
All eyes on the Fed meeting next week. Jerome Powell expected to raise rates. What assumptions are you making in terms of Fed rates trajectory? How will that impact the movements of gold?
So we're expecting the Fed to increase rates by 25 basis points at the March meeting. And then we think for the next three meetings, for the consecutive meetings, we'll continue to see the Fed increasing rates by 25 basis points at each of the meetings, with rates higher by 100 basis points by the end of the year. We do think that they'll pause in the second part of the year as the effect of the interest rate hikes takes effect. For the gold market in particular, we tend to see that investors price in the scope for rate hikes early on. So we tend to see a move in positioning and a move lower in prices ahead of a potential rate hike. So while gold is still taking its cue from real yields, the correlation is still at 60%, the highest it's been in over a year. The fact that there's more concerns about inflation risks and concerns about heightened geopolitical tensions has actually offset the concerns around potential rate hike, and it's continued to push gold prices higher. So we believe we're likely to see gold prices continuing to extend their gains. It's not unusual for gold prices to edge higher after a rate hike. In fact, we tend to see most of the downside risk before the potential rate hike. But we think the concerns around inflation and longer-term inflation risks are likely to actually see gold prices continuing to move higher through the second quarter of this year as we see those rate hikes. Now, in contrast to gold, the move higher in palladium has not been driven on a flight to safety. That's been more of an impact on its supply and demand balance. And the fact that almost 40% of the world's supply of palladium is potentially at risk if there's any supply disruptions that could tighten the market that we forecast to already be in deficit.
Suki, palladium is very, very interesting, given Russia being the major player there. You see, the thing is that while the West tries to strangle the Russian economy, Russia's not powerless in this. They can, as the world's biggest commodities exporter, they have a huge amount of clout to hurt the rest of the world.
If we look at Russia's palladium production, yes, it's around about 40% of the world's supply, and most auto catalysts will use some combination of palladium, platinum, and rhodium as well. 85% of palladium's demand is driven by the auto market. But in terms of Russia's GDP, it makes up less than 1% of its total GDP. But its geopolitical impact is far greater than what its share of GDP indicates. For the palladium market, we can see that there's other countries that produce a significant amount, and we look at end consumers, and we can see that most countries imported most of their palladium from Russia. For the US, for instance, it imported 1.7 million ounces last year, and around about 39% of that came from Russia. So we could see some of Russia's production being consumed by other countries. But at the moment, for countries such as North America, their demand for palladium is in excess of 2 million ounces, whereas Russia produces 2.5 million ounces.
Suki, we know that you don't quite cover nickel, but it's been a phenomenal ride, surging past $100,000. I'm just wondering, how are you reading such movements in the commodities market?
We've seen a great deal of volatility across the entire space. In fact, gold has been at the mercy of headlines around Russia's invasion of Ukraine. And we've seen the geopolitical tensions either spurring prices higher or quickly coming off. So across the commodity space, it's the commodities that are likely to be undersupplied or those with low inventories that are most at risk at remaining volatile. So palladium, for instance, is a market where inventories are incredibly low. The ETF holdings were in excess of 3.5 million ounces and now are less than 500,000 ounces, whereas NYMEX inventories are fallen below 100,000 ounces. So it's these commodities where inventories are low. We're looking at markets that are in deficit. Are the markets that are likely to be most impacted and have, yes, the most upside risk, but also those that have the scope to be the most volatile.